So all businesses and commercial activities, including income from freelance license activities, is covered under the scope of corporate tax. And UAE being UAE, it has a knack of always being at top, and it has come up with one of the most competitive rates, not just in the region but throughout the world. So the UAE has introduced the corporate tax at the single digit rate of 9%. And to further give relief to the SMEs and the smaller businesses and the startups, they have kept the slab rate of 375,000. So any taxable profit up to 375,000 will be taxed at 0%. And any taxable income over and above 375,000 will be subject to a 9% rate of taxation. Now, there will be special rates for large multinationals, which has a consolidated tax revenue of over 750 million euros. That translates to roughly about over 3 billion dirhams. So, which is expected to be in line with the global minimum tax rate of 15%. But once the regulations are out, we would have further clarity on this. And the corporate tax in the UAE will be effective from all the financial years starting on or after June 1, 2023. So the businesses have a lot of time on their hands to take care and to get their house in order. And how Premier Brains can help in this regard will be covered later on in the session. So while we are looking at the inclusions of scope, let us look at a few of the exclusions from the scope as we know of now. So one of the most hotly debated talks of the town was whether the individual salaries will be covered under the scope of the UAE taxation. But the Ministry of Finance as of now has clarified that the individual income from salaries and from their bank interest and from their investment incomes, which are held in their personal capacity, will be outside the scope of the corporate tax. So that's a huge sigh of relief for all the employees. And the dividend capital gains earned by the UAE businesses from the qualifying shareholding, subject to, of course, meeting certain criteria, which will be clarified further when the regulations are out, will also be outside the scope of the UAE corporate tax. And foreign investors' income from dividends, capital interest, capital gains, interest, royalties, and other investment returns will also be outside the scope of the UAE taxation. Of course, there will be certain terms and conditions attached to this. Now, this further reiterates UAE's claim to be one of the most preferred investment destinations, not just in the GCC, but throughout the world. So one of the key considerations in terms of the accounting is in terms of the deferred tax, which I'll be covering in the next session. So what is basically a deferred tax? So the books of accounts, as we all know, is prepared in accordance with the generally accepted accounting standards, which in the UAE is the IFRSs. While there will be different tax provisions in different jurisdictions. So there is a chance that there will be a difference in the profits as per the books and as per the tax laws. So which gives rise to deferred tax. This can be either a deferred tax asset or a deferred tax liability. What we have also seen in case of the VAT law, there are different treatments for revenue as well as expense transactions under the books of accounts and what it is prescribed under the VAT laws. So there are chances that there will be reconciliations between the reporting the numbers as per the financial reporting standards as well as per the tax laws. Now, like I said, that the company's book profits is derived and reflected on their financial statements. So the taxation is computed based on the relevant tax laws. So there will be a difference between the book profit and the tax profit. These differences are essentially called timing differences. So there are temporary timing differences and there are permanent timing differences. So these temporary timing differences are the ones that causes a tax difference which will be adjusted in the future. And And the permanent timing differences are the ones that will not be adjusted in the future. So we will be taking examples on this to understand the terms better. So examples of timing difference. So there are temporary timing differences. This can be caused due to the different rates and the method of depreciation that are allowed as per the books of accounts and what is allowed as per the tax laws. So there can be different rates for depreciation, which is followed by the management for the bookkeeping, and there are different rates prescribed for depreciation under the tax law. There can be different methods also prescribed by the tax law, which is required to be followed and which may be different from what is followed by the management currently. So businesses will need to pay a very closer look to all of this. And provisions, like there are different treatments for provision under the IFRSs and the bookkeeping standards. While under certain tax regimes, we have seen that the provisions are allowed for deduction from the tax base only to the extent that they are paid out. So this can cause a temporary timing difference. Like in case of deferred tax expenses, we have seen in case of other tax jurisdictions where the deferred expenses are allowed straight up in the first year of incurring, while there will be a different treatment for these deferred expenses as per the accounting standards. When we talk about permanent timing differences, which will not be reversing in the future, so like the fines and penalties are generally disallowed under the tax law to be deducted from the tax base. So these are differences which will not reverse in the future. Like the entertainment expenses are also sometimes not allowed to be, for deductions from the tax base. We have seen also in the case of the UAE VAT, where the input VAT on entertainment expenses as prescribed are not allowed to be claimed by the companies, the taxpayers. And certain startup expenses, like the cost of raising the capital, are also we have seen under certain tax jurisdictions are not allowed. This creates a permanent timing difference which are not going to be reversed. So this permanent timing differences does not give rise to a deferred tax asset or liability. So when we talk about deferred tax, it can either be a deferred tax asset or a deferred tax liability. So let's see, when a deferred tax asset arises, when your accounting income is less than your taxable income, that's when it gives rise to a deferred tax asset. So here you are paying the tax liability in advance, rather, and these are future deductible amounts. And deferred tax liability arises when your accounting income is more than your taxable income. And this is related to settlement of tax liability in the future. These are future taxable amounts. We will go through a few examples to understand these terms in better and to reduce complexities. So let's say we go by an example where a deferred tax asset will be created. So let's say the profit before taxes, here is 100,000 as per the income statement, as per the tax statement is also 100,000. Let's say the business estimates there will be a provision for warranties up to 20%. So that is allowed as deduction as per the accounting laws, but such deductions are not allowed on the tax statements. So here the profit as per the income statements is 80,000. Whereas as we see in case of the tax statements is on the higher side at 100,000. So the current tax liability will be calculated based on the tax statement amount, which is 9,000. So this creates a payment of tax in advance, which is a deferred tax asset. So here the corporate tax as per the income statement would be 7,200, while as per the tax statement it will be 9,000. So the payment will of course have to happen as per the calculation in respect of the tax statement, which is 9,000. This leads to a differential creation of deferred tax asset of 1,800. To further simplify it, we can take a look at the journal entries for this, how this will pan out in the books of accounts. So here the current tax expense would be debited in the P&L by 9,000, and there will be a creation of current tax liability of 9,000 credited, and a deferred tax asset would be created at 1,800, and this would give a credit to the current tax expense of 1,800. Now we can go through an extract of the above example, how it will look on the profit and loss statement. So here the profit before warranties is 100,000, the warranty expense is 20,000, so the profit before tax is 80,000. And here the tax expense, which is the current tax expense at 9% of 7,200, and the creation of deferred tax asset, which is related to the future profits, which is 1,800. So your profit after tax is 7,100. And as specified by the IFRSs, the deferred tax assets and liabilities are to be shown as non-current assets and non-current liabilities on the statement of financial position. So we have presented a short extract of that as well for further clarification. Let us take an example of how a deferred tax liability would come into picture. So let's say the profit before depreciation is 100,000 as per the income statement and tax statement. Now the depreciation, let's say it's 10% as per the accounting standards, and let's say it would be 20% allowed as per the tax law. So the profit, as we see, is higher in case of the income statement as compared to the tax statement. This would lead to creation of a deferred tax liability because the current tax will be calculated at the lower rate. So your corporate tax 9% on income statement is 8,100, and your corporate tax 9% for the tax statement is 7,200. Payable liability is as per the tax statement of 7,200. This creates a differential liability of deferred tax at 900. We'll again take a look at how the journal entry for this will have to be passed. So your current tax expenses will be debited by 7,200, and your current tax liability will be credited by 7,200. And here your current tax expense will again be debited by 900, and for the creation of deferred tax liability, which sits on the balance sheet. Let us take a look at the extract of how this might look on the profit and loss statement. So your profit before the deduction is 100,000 less the depreciation of 10,000. Your profit before tax is 90,000, and your current tax at 9% is 8,100, and your deferred tax liability creation at 900. So your profit after tax is 82,800. And the presentation of the same on the deferred tax liability on the balance sheet would be as non-current liabilities as we discussed earlier. Now, above covers the situation where there is a deferred tax asset in case of profit. But what in case the company incurs a loss? This would essentially be in the initial or the startup phases where the companies might have certain tax losses. So as the Ministry of Finance has clarified that the UAE corporate tax regime will allow taxpayer to carry forward their business losses to be set off against future profits. So deferred tax asset will be created for such tax losses for offsetting future tax payments. And the deferred tax asset should be created and recognized only to the extent there is a certainty that there will be future taxes, future profits available to set off these losses. So the business will have to carefully consider and analyze whether there will be future profits available to offset these losses. And of course, as we have seen in case of other corporate tax regime in the region as well as worldwide, there can be a cap to the number of years these taxes can be carried forward. So every year, these deferred tax assets will also need to be tested for impairment and compared to the projections that the businesses have about their future profits, especially in the current scenario where the businesses, the startup culture, where there is a high cash burn and high losses in the initial stages, and the profitability comes at a very later stage. So for the deferred tax asset and liabilities, There will be disclosure requirements also as required by the IFRSs. So there is a requirement of reconciliation of how the income tax provisions and the company's income tax liabilities have been determined. So there will be a separate notes to accounts for that. So the auditors will also need to be careful about these inclusions in the audit reports, and detailed information regarding derivation of the deferred tax asset and liabilities, and regarding what base the companies have taken for their future income for the recognition of these deferred tax assets in case the company is incurring losses. So businesses will need to carefully consider all of these, since these provisions are fairly new, and the region is not accustomed to these disclosures and these accounting standards. For the next set of slides, I would like to hand over the presentation to my colleague, Mr. 𝐜𝐨𝐽𝐻, who will be taking over the permanent establishment and the accounting and the bookkeeping requirements. Thank you for your time.
Yeah, thank you, Jinesh, for the hello. Yeah, thank you, Jinesh, for the wonderful and basic insights of the corporate tax, and also you covered a very we can say a new topic to the UAE market, which is deferred tax. So thank you for that wonderful insight. So let's now go cover the next part of the slide, which is a permanent establishment. Please, can you move to the next slide? So why permanent establishment needs to be identified? So let's understand this by a small example. So consider if a corporation has a fixed establishment in two countries where they are generating a revenue, then establishment has to identify in which countries they are required to pay the tax, or in which jurisdictions they are comply with the tax regulations. So there are the different tax treaties between the home and host countries that needs to be looked upon, and they define the permanent establishment. So the general definition of permanent establishment means a fixed place through which a taxpayer doing a business wholly or partially. So here three conditions are important to notify. Like there should be a place of business, a fixed place, and business activity has to be happened there. If these three conditions are satisfied, then a company can say that they are having a permanent establishment in a particular jurisdiction. So if we can give one more example, suppose there is a US company which is having a UAE branch. So based on that, if a branch is having a physical office, they are doing a business here, then in such a case, a branch is having a fixed or permanent establishment in UAE. So a few of the examples are a branch, office, factory, workshop, building site, or extraction or explorations of oil, gas, or natural resources. So the common thing with all the example is that they have a fixed establishment which they are located and they are doing the business. So these are considered as a permanent establishment. So another requirement to consider establishment, we can say that when the dependent agent doing a business for a taxable person in a particular jurisdiction, then in such a case also it can be said that that establishment having a permanent establishment in UAE. So can we move to the next slide? So why it is what is the importance of the permanent establishment, or why every corporate needs to identify that permanent establishment? So first of all, if company or corporate identify their permanent establishment, so based on that they can decide which jurisdictions they are required to pay the taxes. Based on that they can decide which jurisdiction they are required to pay the taxes. Also, for if you continue the example of US and UAE branch, so suppose in a USA there is a tax rate of 15%, and UAE there will be a tax rate of 9%. So there can be a cases that USA company is required to pay the tax for UAE branch as well. So if the permanent establishment is not identified, so the permanent establishment identification is required for the tax benefit as well. Also, there are the tax treaties between the UAE and with another 130 countries. And generally, as per the tax treaties, tax paid in the host country will be allowed to claim as a deduction in the home country. So if we continue the example, whatever tax paid by a UAE company or UAE branch, maybe US company claim the benefit of that 9% tax paid in the USA. Yeah, can we move to the next? So companies has to check all these things while they are facing this kind of a thing. Now, yeah. So how the corporate tax rate for this permanent establishment in different GCC countries? So in KSA, 20% flat rate is applied on all the corporate. In case of a Qatar, it's 10%. However, in Kuwait, if we see that 15, Kuwait, the tax rate is 15% only on the foreign corporate businesses. So for the local businesses in Kuwait, they are not required to pay the corporate tax. In the Oman, that tax rate is 12%, including the branch of a foreign company. But the same which I have explained in the earlier slide as well, that whatever tax paid by the branch, if HO is liable to pay the tax on such income, then they can take the claim of that tax paid in this jurisdiction because of the double treaty entered between the Oman or a USA, or maybe in a future between the UAE company and UAE and any 130 countries which we have mentioned earlier. So now these are the permanent establishment concepts. So basically, every company has to identify their permanent establishment, and they accordingly they have to manage their books of accounts. So let's move to the another topic of this webinar, which is accounting, record retention, and audit requirements. So as we have seen, accounting records are the key source of information and evidence of the business situation. This document also required to prove the ownership of the creation of the liability or assets held by the corporate. So as we know, before the implementation of VAT in 2018, many SMEs were not maintaining the accounting records. Or if they were maintaining the accounting records, these accounting records were maintained on the Excel files, which can be which will not be allowed as a proper documentation by the tax authority. So the continuation of a VAT regime in past 4 years, we have seen that now SMEs has moved on and they have started to maintain their accounts in different accounting software. But here also we have seen that these accounting records are kept as per the requirement of VAT. So basically, they are companies are booking the sales and recording the expenses, but that are not maintained as per the requirement of basically IFRS or US GAAP, which is generally accepted accounting standard. So the company has to consider the preparation of accounting records. Also, MOF has on his FAQ for the corporate tax, they have mentioned that the companies can maintain their books of account as per the generally accepted accounting policy. So companies should start to maintain the books of account as per the IFRS or the US GAAP. Also, the another questions arise. There's that what are the documents that have to preserve for their accounting records? So companies has to preserve all the documents which is used for the preparation of accounting records, like the sales invoice, contract with the supplier, contract with the customer. All these documents has to be preserved for the supporting of the accounting records. Then also the other thing we would like to mention that the many free zones and licensing authority has made it compulsory to do the books of account gets audited and needs to be submitted to them within 3 or 6 months of the completion of financial year. But this and also company law of UAE that also suggests that the company should do their books of account gets audited. But this is not actually being followed in a uniform manner everywhere. So companies has to start to think about the maintaining their books of account get audited, and this is the key requirements or why it's required. Basically, when can we move to the next slide? So what kind of accounting record needs to be maintained? So generally, a company has to maintain the general ledgers, which will have all the transactions entered by the company during the financial years. Company has to maintain their stock records, which stock records mainly shows the quantity and value of the material received, material issued, and party to the material issued to the different departments, or material issued for the sales or for the production. These are the essential records to claim the expenses in a future. Then other records are sales purchase register, expense register, which will reflect the whatever sales made by the company during the year, purchases done by the company, and expense register is necessary because Jinesh has also mentioned earlier in the earlier part of the slides that UAE VAT law also says that certain expenses are not allowed as a deduction for the input VAT claim. The same with the corporate tax. There might be the chances that entertainment expenses or this kind of expenses will not be allowed to claim as a deduction. So companies has to make a proper register. It has to identify the expenses which will be allowed as a expense allowed as per the corporate tax or not. Then in addition to the records maintained above, authority may require any other information in order to confirm any liability registered for the tax purposes. So business may be required to make changes to their core operations, financial management practices, procedures, and they used to keep the accounting books and records and technology. Can we move to the next slide? As we have mentioned that companies are required to maintain these books of account or accounts as per the requirement of your generally accepted accounting process. But what if these accounts are not maintained or it will not be available for available when the tax departments ask for the review? So in current VAT regime also, we have seen that if the authorities ask for the records and it has to be provided within 5 days of the 5 working days when they have asked. If they are not provided within the timelines or if they are not maintained, then authorities are putting fines or penalties for the non-maintenance of the accounts. Then what is the other consequences? That if the proper accounts are not submitted, then department may make assessment due on taxpayer using the estimated tax method according to the facts and circumstances pertaining to the taxpayer. So in such a case, if proper accounts are not maintained, so if a tax authority may review your bank statement, decide that this is the income and these are the expenses which is available. So and they will assess the tax payable to the authority. So if there are some genuine expenses done by the businesses, but for that accounting records are not available, in such a scenarios, companies might have to pay the additional tax because of the non-maintenance of the document. So companies has to ensure that proper accounting has been done, proper documentation has been made. And the last point is tax authority may disallow. Yeah, that's one of the good point is the authorities may disallow the claim of expenses as well. So that's in a VAT regime also it is there that if proper suppliers invoices are not provided to the authorities, they can ask to remove the input tax credit on that. The same can be happen in case of a corporate tax as well. So companies has to look into the current situation, and if the proper systems are not in place, company should basically go and do the proper analysis and implement the accounting system, as well as they have to start to maintain the records. Also, for the record maintenance, another question may arise that whether it should be maintained physically or digital manner. So currently, we are expecting, and as per VAT law, also they are allowing to maintain the document on a digital form as well. But correct record has to be maintained, or like a proper documentation has to be provided if the documents are digitally managed. Can we move to the next slide? Yes. So one of the another question arrives, like what are the audit requirements will be in a corporate tax? Here are the few examples or examples of the corporate tax audit requirement in different GCC jurisdictions. So as per the KSA law, taxpayers whose taxable income exceeds 1 million Saudi riyal, they have to do their books of account audited by the certified licensed accountant who is practicing in Kingdom of Saudi. Same with Qatar. Qatar, this limit is this limit is based on the two factors, which is one is capital exceed. If the capital if the company's share capital exceeds the Qatari riyal to 200,000, or its total income exceeds the Qatari riyal 500,000. In such a case, a Qatari company who required to do their books of account audit. In case of a Kuwait, all the FCBs, foreign corporate businesses, they have to do their books of account gets audited. In case of Oman, the limit is basically prescribed based on the share capital. So if the paid share capital is in excess of OMR 20,000 dirhams, in such a case, Omani company has to do their books of account gets audited. In UAE also, currently we are waiting for the law to prescribe any specific limit or something, but it is expected that the audit requirement will be there in the corporate tax law, so that way they can when companies are filing their annual tax returns, they might need to submit the return with the audit requirement, with the audit report, or at least they have to submit their management accounts if they are not there is a specific limit. Okay, can we move to the next slide? Yeah, that's for the permanent establishment and accounting records requirement. So now I would like to invite Rishi to let us take you through the way forward.
Thank you, Jinesh and Hemal, for the wonderful session. Now that we know that the corporate tax is not far away, so time to start preparing for it in advance. So can we move to the next slide, please? So basically, as you can see, there are 4 stages mainly which takes place in the implementation of any tax law for that matter. I still recall when the VAT was implemented into that time, and this process of following these 4 steps has actually helped a lot in a smooth sailing, I would say. So the first step, the impact assessment, just so that you know what it means, is normally to prepare well in advance before the corporate tax is been implemented. The question is somebody can ask, like, okay, the law is not there, so what to prepare, what to do? So as you might know that even though the law is not there, but there is a notification or there's a questions been issued by the Ministry of Finance, which actually talk about many things, not maybe in very detail, but covers a lot of areas. So things such as, about the tax will not be on free zones. However, it will be on mainland companies. Now, but you can see many free zones when they operate in UAE, they do a lot of business with mainland companies. So now in order to see what is the impact going to be, like just a company working in a free zone and doing business with mainland, I personally do not expect that they will be left out to enjoy the tax benefits just because they are in the free zone. So this area needs to be looked at. How big is the volume of those transactions? Then that, as my colleague Jinesh talked about, the temporary differences like the depreciation rate, carry forward of losses. So what are those impacts? Another question is, we don't know what are those rates in the tax law. However, we still have many GCC countries like Oman, Saudi, where the tax is already implemented. So we can draw conclusions or take things from that. So see what's the impact, expected impact that can happen on the company's financials. So you have your own depreciation rates, but you can always refer to the laws which are around GCC to see what are the likely impact that may happen. That will help in preparing a little bit. And then many permanent differences, which Jinesh talked about, to look into it, what's that adjustment that's going to happen. Another important area is the impact on the cash flow. So maybe you have a profitable financial statements, but not always cash is there because you have receivables sitting in the books. So what are the cash impact that's going to happen? It's good to know about it in advance, at least, run a high level in terms of, the tax that might, though the tax rate is not significant enough, but still it's always better to have it planned. Then just to look at it overall, does your system has enough system changes, not changes, I would say system equipped with handling the corporate tax or not? When I remember when the VAT came into picture, though we had good systems in place, but some of the system has to be actually completely taken off and move to a new one in order to comply with the requirement. So it's always better to see the systems which you follow has enough capabilities to adjust with the time. And then the training levels of team is very important because the tax is always a changing system. Even now with VAT, as we know, it's been many years since the VAT has come. But even today, every month, there are changes, there are new notifications, clarification, which can continue to bring more clarity to the law. So the team has to be really good and they should have the right skill set to handle the changes. Another point which my colleague mentioned about is that there is option of tax grouping. So that needs to be looked at. If you have many companies, how efficient it is going to be. So that 375,000 limits, is it going to be at entity level or at the group level, or how it's going to happen? So that needs to be looked at. So if your company is also getting your financials audited, so it's important to look at your financial this year more closely to see so what kind of tax planning you're going to do. Because if certain tax planning changes are done right on the year when the law is implemented, then the authorities might not take it very positively, saying that it has just been done to turn around things and not the real transaction. So if you have to really do certain changes, better to do it 1 to 2 years in advance of it, so that it looks like a normal flow of business. Then my colleague also mentioned about transfer pricing rules, the OECD and transfer pricing rules. So if you have a lot of related party transactions, I think it's time to look into how fair valued are those transactions, are those really at arm's length or not, and not to wait a long time before the law is implemented. So it's better to bring updated rates and things like that. So that's important. So the planning always starts way ahead of time. So I'm sure most of us have seen that in VAT when it was implemented. So the second step is after the impact studies, the detailed assessment and design. Therein we looked at systems a little bit more closure in terms of does it have the kind of schedules required, the team is properly trained. Now, the important thing that will be required at that stage when the law is already been introduced is that to see what are the allowable and non-allowable expenses. So that is going to be very important, because that will straight away impact the calculations of the tax. And so it also means if there is a way to restructure your transaction so you have more allowable expenses and less non-allowable expenses. So that's going to be an important question to answer at that stage. And then we come to the implementation stage, where the law is already there. So then you have to look at your record keeping structures. Do you have enough processes to keep records in a proper shape? I'm sure after the VAT implemented, a lot of companies are doing record keeping in a proper way. However, still there are weaknesses, because the VAT is mostly on the on the sales side or on the expenses side, where you have input VAT and output VAT. But what happened to the rest of the transactions, say salary payouts or management fees and many other things which are sitting in the profit and loss account? So are we keeping proper records for that? Do we have actual agreements in place for recording those transactions? So those needs to be looked at in advance. And stock records is going to be very, very important, especially the company in the trading business. So that has to be kept in more proper way, I would say, based on what I see. And then the operating cycle, the last one is wherein the law is already there and you have to just go and start filing the returns. And again, record keeping after filing returns, so your books are reconciling with what you have filed, is going to be a very, very important factor, and how your backup of all the data has been kept. And then, of course, doing timely audits and doing proper checks is going to be an important factor, because what happens, like in VAT, it's been many years since it is in practice. However, the audits have started for many companies already. Many companies have not been touched as yet, but because they can come back to any company within a 5-year window, so every company at some stage will get audited. So that mindset has to be there at the time of operation, that you are ready for any kind of tax audits that's going to happen. Okay, so can we move to next slide? So three elements are important very clearly: process, technology, and the most important is people, because people will drive especially the proper filings and record keeping. So I would say processes and technologies still, after the VAT, a lot of things have been already done. And I'm sure the softwares will change very fast with the new laws implemented. But people training is going to be the most significant one. So encourage your team to take active participation in learning the law. And once the law is implemented, after my experience with the VAT, is that people tend to just forget about reading the new clarifications. So staying updated with the changes is the most significant factor, because sometimes once the tax audit happens, some of the things which were perceived at the beginning is not been how it is implemented later on. So that's going to be an important factor. So next slide, please. So these are some bullet points which will help you think a little bit deeper into it. So as I already discussed, restructure the existing tax structure. I mean, already you have management accounts with you, and you know how you're reporting, what profit or losses you are making. Another thing is carry forward losses is going to be, if there are companies on losses, there will be expected possibly time restriction or the value restrictions. And so it's important to think about that. And so if you have a lot of companies, whether to group it to make use of the losses or kind of bring it tax efficient, that's a decision to be taken much earlier before you do the registrations. Transfer pricing is going to play a very, very significant role, because so far in UAE we don't have a transfer pricing rules. However, in Saudi, like we deal there in some cases, they have transfer pricing rules. So this is going to be an important factor. I'm sure multinational companies already have such practices in place, but the local companies might have to spend a little bit time on looking at what it means in transfer pricing. So there are very, like we have done study at our end for, how do you actually do the comparison for transfer pricing. But it's important that companies should start looking into it right away rather than waiting long time, because you have to align your prices way ahead before the law is implemented. Review your existing records and control. As I already mentioned, that after the VAT, there are a lot of record keeping done. But again, that is only from your sales and your VAT expenses point of view, but not from the view of other expenses or other balance sheet items which are sitting there. So all that has to be, so it's going to be the whole cycle needs to be captured in a proper way. Though many companies are doing properly, but still, based on experience, since we do a lot of audits, so we still see many cases, things are done without agreements, without proper paperwork. So it's important that this needs to be taken a little bit of more care. Update your IT infrastructure to suit the requirements. Documentation management is definitely going to be important point. And the last point is very, very relevant, is updating the stakeholders on tax impact is very, very important, because normally the stakeholders, I would say shareholders, are not reading the law as you and me would do. So there will be a little bit of nervousness with the tax coming in. So it's important to talk to them, keep them updated about what's going on, what's the impact on the financials. So they really understand it and really assist you when the law is out there. So these are some of the important points I think it's important to discuss at this stage. So can we go to the next stage? Next slide, which comes to Q&A session. So I think we have few questions. So I'll just volunteer to start from the beginning and take those questions and let our colleagues handle it. So the first question is, Saeed has asked this question. Jinesh, can you please open your video, and Hemal, and can you take this question? So the 9% above 375,000 will be applied on the whole amount or the excess of 375,000?
So essentially, Rishi, as it is mentioned on the MOF website, MOF is FAQs. So the 9% will be applied on all taxes, on all the profits over and above 375,000. So up to 375,000, it will be taxed at 0%, and any profit above 375,000 will be taxed at 9%.
Right. Thanks. I think Saeed, it answers your question. So you very clearly tried to mention that whether the tax will be on 400,000 or 400,000 minus 375,000. So he clarified that it is 400,000 minus 375,000. So that's there. So the good point maybe to look at from your end, if you're looking at tax grouping, is whether the tax will be at entity level or the group level. This is a question for another session, because we have to take up other questions. So the next question Saeed is asking is there any restriction on ERP or accounting software for recording? I meant it's specifically a small business which may sometimes even be using Excel for accounting records. So the question in a way means, do you need an accounting software, or you can still carry on with Excel?
Okay. So say basically, currently in the law, it's not defined whether with any specific accounting software will be required. But in VAT law, FTA has accredited few softwares, and they have mentioned that it's a FTA accredited software. So it is ideally company should use that. That's more advisable. And also your next question is, did amortization of the past year losses allowed? So on FAQ issued on the MOF website, they have mentioned that the company will be allowed to claim the past losses. The same my colleague Jinesh has mentioned in the first set of slides. So that will be allowed as a deduction for against the future profits.
And just
Okay.
continuing on Hemal's point here regarding digitization, the recommended thing to do here is to put your accounting into a software, because like we mentioned, there are a lot of complexities involved, like the deferred tax asset and deferred tax liability and certain other complications as well. So
sorry,
it is always recommended.
Jinesh, I would have to cut you here because we are running short of time. We are just about 1:30, so I will just have 5 more minutes. I think Hemal has covered it. So Saeed, if you can just drop an email to us, and I will have Jinesh talk to you one-to-one if that helps. So Ubaid Arif has asked, what is the taxable income? If I will do business without permanent establishment in UAE, will it be taxable in UAE? Hemal?
Yeah, so basically taxable income is your profit less like your revenue less deductible expenses as per the corporate tax law, and whatever is arrived, it is considered as your taxable income. So basically deductions and what are allowable and non-allowable expenses that we can come to know after the law comes into the picture. But general non-allowable expenses are entertainment expenses or many provisions, which like Jinesh has covered in the deferred tax slides. So which are not permanent differences.
Right. So Fabi wants to know, how do we access the notification from Ministry of Finance? Basically, she's referring to the website link where this notification is issued. So would you be able to, I think, Yash, can you send that link to Fabi separately so she can access, or if there is a link handy with you, put it in the chat window so everybody can look at it.
Sure. I am putting it in the chat window.
Yeah, so Fabi, you can just have a look, go through it. It's always good to know what's written by the ministry. Right. Thanks, Aparna, for your message. Yes, we will be sharing the presentation later on. And then, so next session with is requesting for tax planning. I think for that, I've already shared some of the ideas with you. The more we can only do when the law is out there, but what important is to look at the impact study right now, which there is a lot of things that can be done. So generally speaking, I've already done that. Specifically, we can take up separately if you like to. Same, Fabi, the answers is same. So if you want to discuss one-to-one, you can talk to us. Generally, I've already discussed. Then we have to wait for the law to go more deep into it. Lalit no, before that, Niranjan is asking, if a company has license in mainland and free zone, whether required to keep separate books, how about tax payment? Hemal?
Yeah, sure. Here he's basically what you are referring, whether both are the separate companies or like one company is having a branch license in a free zone. So
no, okay.
So if both the companies are separate, then it's always companies has to maintain their separate books of account. But if it's a branch, then a company can maintain a one set of books of account.
Yeah, but anyway, from the VAT point of view, we must be keeping separate books, because if you are in, for example, a designated zone, the rules are different for a designated zone in a mainland company. So you might be keeping, if you're not in a designated zone and you have a free zone, you can keep, together for a branch, as Hemal said, but it's always better to keep books separate, especially with the taxation coming in picture. It's always better to keep books separate, because free zone will be outside the scope. However, we still will have to see what is the impact of transaction between free zone and mainland. That's going to be another point to look at in later days. So Lalit Singhi wants to know how accumulated losses prior to corporate tax of an entity will be treated. How many years prior losses will be allowed?
Okay, so as like I mentioned earlier to the earlier questions, that prior year losses will be allowed to claim adjust against the future year profits, and how many years. So like during the last webinar, we have like discussed the different jurisdictions allowing different years. So for UAE currently, like we have to wait for the law to basically set any specific timelines to allow the prior year loss.
Right, thanks. So Niranjan, for previous sessions, it's on our website and also on our YouTube channel. So if you spend some time, you will be able to find that. Thank you everyone for your lovely messages. I think that brings us end of the session. We are 4 minutes late, sorry for that. So we'll catch up later on with another session very soon next month. Thank you very much. Have a lovely day. Bye.
Thank you, Rishi. Thank you, everyone.